Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Today I want us to study about preparation of the statement of cash flows, I want us to study the preparation of the statement of cash flows in line with International Accounting Standard 7. Today I don't want to teach you the conventional way of preparing the statement of cash flows, because I know at least if you are doing your CPA 1 exams or ATD 2 exams or even CPA 3 in terms of financial reporting and advanced financial reporting, you've come along this term, and therefore I'm not going to delve so much into the whatever is taught. I want to teach you about what you may never find in any exam: how to approach this question, how to make it very, very easy. I like telling my students, it is easier to pass the cash flow exam more than any other, but many students say it is one of the most difficult topics. So today I want us to just define two terms only. I want us to define two terms as used here, and then I want us to define two terms here. Number one is cash, and the other one is cash equivalent. Number one, cash will mean cash and demand deposits. What do you mean by demand deposits? These are deposits you can easily get. Go to the bank, you have given them you have deposited the money with them, and they are giving you something small in terms of an interest, but you can pick that money anytime. Without any loss in the value. Now, cash equivalent, we say it is short-term investment. It is a highly liquid short-term investment which can be easily converted into cash without significant loss in the value. Now, cash equivalent is highly liquid short-term investments which can be easily converted into cash without significant loss in the value. These are investments which can be easily withdrawn from the bank without any penalties from the bank because you have withdrawn. Basically, this ones include things like treasury bills. So when we talk about the preparation of statement of cash flows, I want to explain, out of my 16 years of training, the things I want to explain to you are things you don't get in conventional books. But out of my 16 years of training, I have come to develop them. So the first thing, when you get a statement of cash flows examination, you will be given either two balance sheets, and you'll be told to prepare the statement of cash flows, or you'll be given income statement and two balance sheets. You'll be given income statement and two balance sheets, or statement of financial position. Now, I like telling students, anytime you find yourself with the income statement, There are things you're being told to do there. There are things that you're being told with the income statement. Number one, it may help you get profit before tax, profit before interest and taxes, before interest and taxes. Number two, it may be helping you to compute interest expense, interest paid against interest incurred, dividends paid against dividend incurred, and tax paid against tax incurred. What am I saying? I'm saying once you find you have an income statement, there is something you are being told. There is something you are being told. There is you will need to create. You will need to get profit before interest and taxes. You need to get profit before interest and taxes to start your statement. To start your statement of cash flow, you need where you find that within the income statement we have a finance charge. We have something they call finance charge. Anytime you find finance charge in the income statement, you must know that you are referring to interest. You are referring to interest. And you know in the income statement, we capture the interest expense charged. What was incurred, not necessarily what we paid. What was incurred, not necessarily what we paid. When you find dividend as an expense in the income statement, it is what was declared, what was incurred, not necessarily what was paid. When you find the tax as an expense, it is what was incurred, not necessarily what was paid. And therefore, every time you find yourself having an income statement, you need to quickly go look for those four things. Go look for profit before interest and taxes to capture it in your statement of cash flows. Look for interest. And what you do, as you find there is something called finance charge in the income statement, you quickly go to your balance sheet and you'll find whether among your current liabilities there is interest payable. If you find within your balance sheet there is a current liability called interest payable, you are being told now reconstruct your account. You don't reconstruct your account. Now, what you are being told is that the balance sheet will give you the balance brought down. The balance sheet will give you the balance brought down and balance carried down. Now, the balance sheet will give you the balance brought down and balance carried down. The balance brought down is the opening. Not be that will be because it's a liability. Interest payable account. It's a liability, so we have balance brought down and balance carried down. Now, we know, look at this. We know this is a liability account. Interest payable is a liability account. You are being told that the interest payable at the beginning of the year was this amount, but then in the income statement, you are being given the charge for the year. So you are increasing the liability. You're increasing the liability with the charge for the year. The liability you had at the beginning of the year with the total charge for the year gives you the total amount. Beginning and charge for the year gives you a total amount, but you are told out of the total amount, then the balance is this. And therefore the balancing, the missing item must be what was paid. What was paid through bank. The opening liability plus the charge for the year gives you total liability. If you get the total liability, you subtract the liability at the end of the year, you will get what was paid. And therefore, when we are preparing our statement of cash flows, we will add back what was charged because we are dealing with the cash outflow, what left to the farm, not what was incurred. So we will add back what was incurred or what was charged, and we will subtract what was actually paid. What was actually paid. And that is why at times you'll find us talking about profit before interest and taxes. Profit before interest and taxes. Now, if you are given profit after interest and taxes, you add back taxes, you add back interest to get profit before interest and taxes, because whatever had been deducted was what was incurred, not what was paid. So you get before interest and taxes, so that when it comes now to the operating activities, you're going to deduct them, the actual amount which was paid. You're going to deduct what was paid, not what was incurred. Not what was incurred. You will do the same for dividend account. You do the same for dividend account very fast. Dividend account very fast. And you say it's a liability account. Balance brought down. You got the balance brought down. You get the balance brought down. And the balance carried down. Balance carried down. Now, then we get a charge for the year from the income statement. You get a charge for the year from the income statement. What you had is a liability at the beginning of the year plus the liability incurred in the course of the year gives you total liability. You subtract what was remaining, the balancing figure is what was paid. The balancing figure is what was paid in terms of dividend. And therefore, we get the profit before interest and tax, and therefore before dividends, and then we deduct dividend. And we know that dividend is a long-term, is part of our investment activities because they are being paid to ordinary shareholders or preferred shareholders. Dividends is a financing activity. Dividend is a financing activity. We do the same for tax. So we open tax account. You open tax account and you say balance brought down at the beginning of the year. Charge for the year as shown in the income statement. The income statement shows what was incurred, not necessarily what was paid. Not necessarily what was paid. So you say balance brought forward. The balancing figure here is money paid. In terms of tax. It is the money paid in terms of tax. That is the main reason of having the income statement. Those are the four main reasons. Number one, to get profit before interest and taxes for the cash flow. Number two, interest paid, the actual paid, because the income statement shows what was incurred. Usually what was paid is usually less. The dividend paid, not necessarily what was incurred. The tax paid, not necessarily what was incurred. Already, you are getting marks. By just getting this, you're getting marks. It is that simple. Please note what I'm doing. Then, after that, after you're through with the income statement, you go to the balance sheet. At the balance sheet, you move from the beginning to the end of the balance sheet. Number one, you deal with the non-current assets. And how do you deal with the non-current assets? You reconstruct their accounts. Based on the information given, you reconstruct their accounts. You may find that we have, maybe you have an account called property, plant and equipment. And therefore, because of the two balance sheets, you have the opening balance and the closing balance. So from the balance sheet, you get the balance brought down, and the balance carried down, Now, one of the most important things is we handle the non-current asset, especially PPE, is to ask yourself, was there any revaluation? You got down to the financing, ordinary share capital, share premium, revenue reserve, capital reserves, all of them. You check whether below there we have revaluation. If we have revaluation, you'll come here and you say revaluation account. You must be careful. Now, if the question was giving you PPE before deducting depreciation, you will need to deduct depreciation so that we can check the movement net of depreciation. You can check the movement net of depreciation. So what you realize, at times you are given the what was purchased and you're not given depreciation. Or you are told the depreciation was this amount, so you add the depreciation, and therefore the balancing amount is what was purchased. What was purchased through bank. Now, in this account, we know that what was purchased through bank and the depreciation charge for the year are supposed to be used in the preparation of the statement of cash flows. The depreciation is a non-cash item adjustment. Non-cash adjustment, and bank, we are buying a non-current asset, and therefore it's an investing activity. It's an investing activity. If we are buying, it is a negative investing activity. It is an investing activity. And that's the way to look at the PPE, the non-current assets. Now, at times, it may not be as this simple. You may have several items of PPE, land and building, plant and machinery, and one of them is described. The movements in it are well described. This is what was purchased, or this was the depreciation. Meaning, the missing item is clearly described there. It could be either depreciation or the bank. Now, where the explanation has been given, you cannot take revaluation. But where the other non-current asset, where we have not been given the explanation, that is where we take our evaluation. That is where we take our evaluation. Now, there is an important non-current asset called investments. If you go to the non-current assets and you find investment, it means that this is a non-current investment. A good example is when we buy shares in a company and we don't plan to dispose them in the near future, in the foreseeable future. So it becomes an investment. It's not tangible. It's not a PPE. It's an investment. And therefore, because we always say investing activity in the statement of cash flows deals only with non-current assets. It deals with non-current assets, be they PPE, fixed tangible ones, or intangible. Never forget that investment part of the statement of cash flows deals with non-current assets. And therefore, even if it is an intangible asset, but it's a non-current asset, it's an investing activity. It is an investing activity. And once we invest, we expect interest income. We expect interest income. And therefore, the movements in our investment when it is a non-current asset is an investing activity, and the interest income or dividend income is an investing activity. It is an investing activity. Remember that there is a big difference between when we invest in other companies' shares. We buy their shares and therefore we expect them to pay us dividend, or we buy their bonds and therefore we expect them to pay us interest. Now, the interest income becomes an investing activity, but when people invest in us and they buy our shares or they buy our bonds and we are paying them dividends or we are paying them interest expenses, it becomes a financing activity because we are paying because we are being financed by them. And therefore, I want to repeat again, this investment, if there is a movement in the investment account, if there is a movement in the investment account, balance brought down, balance carried down. And we know if it's an increase, if we are increasing, if we are buying through bank, then never forget that this is an investing activity. This is an investing activity. The temptation to think because it is investing, it's operating is very high. but this is an investing activity. Not only that, you may find that we are disposing some investment. You are told we dispose some investment which was at the value of 20, and we are disposing it at 30. Get the value of 20, we are disposing it at 30. Now, that is gain on disposal of 10. Gain and disposal of 10. That gain and disposal of 10 must be adjusted as a non-cash item at the operating activities. Must be adjusted as a non-cash item at the operating activities. I have now dealt with the income statement. I've dealt with the non-current assets in the balance sheet. Now I go to the current assets. Now I go to the current what? I go to current what?
Assets.
We go to current assets. Now we know how to handle current assets and current liabilities. We know our current assets. Our current assets include inventories. They include what? Trade debtors. They include sundry debtors. They include bank. Actually, they include, again, investment. Again, they include investment. They include bank. And they include cash. They include cash. Never forget this. Never forget this. Never forget this. We say that there is something called cash equivalent. Cash equivalent. We say cash equivalent is a highly liquid investment that can easily be converted into cash without significant loss in the value. And therefore, the three of these, we say they are called cash and cash equivalent. Cash and cash equivalent. And therefore, we do not look at the movement to take them in either working capital changes or operating or even financing activities. So the three of them, anytime you see investment above bank, it means that is cash equivalent. These ones are cash. These are cash. We say that cash means cash, money in hand, or money in the bank, or any demand deposits. Any money we have kept in the bank, but you can go and demand it and get it. Now, we are saying the three of them are added together to get cash and the cash equivalent. What we are looking for is the movement of the cash and the cash equivalent. It is the movement of cash and cash what? Cash what? Equivalent. Now, these ones, we do what is called working capital changes and adjustments. Working capital changes and adjustments. And we say inventories increase. It is like we have bought inventories and therefore it is an application of funds, we bracket. If it's an increase, we bracket. If it's a decrease, we do not bracket. If it's a decrease, we do not bracket. We do not bracket. For trade debtors the same, for sundry debtors the same. And we also even have things like prepayments. Now, all of them, the treatment is the same. For inventories, trade debtors, sundry debtors, and prepayments, an increase, we record it as an application. We have spent money to acquire it, and therefore we bracket it. But a decrease is like we have sold, and we are getting money. And that's the way to now deal with current assets. That's the way to deal with current what? We go down in our balance sheet. We are dealing with the balance sheet. We are dealing with the what?
Balance.
We're dealing with the balance sheet. Now we go down. Now that we are through with the current assets, we now go to the financing bit. We go down to the financing bit, and we know when we sell shares, when we sell shares above par value, we debit bank 100 millions. Assume we are selling 1 we are selling 1 million, 1 million shares. We are selling 1 million shares, and the par value, if we say the par value is 10, but we are selling at 20. If the par value is 10 and we are selling at 20, what we will do, we will come and we will debit bank and we will say, we get 20 million. We have received 20 million in the bank. We have received 20 million in the bank, but we credit ordinary share capital with 10 million. We credit ordinary share capital with 10 million and share premium with 10 million. 10 million. 10 million. Yes, that way. Yes, that way. So when we are recording, when we are selling shares, we debit bank, we create ordinary share capital and share premium. And therefore, when we now come to reconstruct the share capital account to know how much money we got because of selling of shares, we do not put the share premium separate from the ordinary share capital. We come and we say ordinary share capital plus share premium account. Ordinary share capital and share premium account. And therefore we get the balance brought down of ordinary share capital and share premium. We get the balance brought down of the two. And then we say balance carried down. Balance carried down, ordinary share capital and share premium. And then we get the balance. We get, now, definitely, the difference between the closing, more often than not, you find that this is bigger than this. Meaning, we issued shares. We issued shares through bank, we debited bank, and we issued more shares. This will help you to discover how much money did we acquire in terms of selling of shares. You reconstruct this account. Now we are in the financing side of the balance sheet. You reconstruct this account to see the amount of money we acquired through the issue of shares. When we issue shares, this is a financing activity, because we say financing activity is anything that is related to the long-term funding of the firm, where we got long-term funds, ordinary share capitals and their dividends, preference share capitals and their dividend, debentures and their interest expenses. So we do it that way. We do it that way for the ordinary share capital. Once you are through with the share premium, ordinary share capital, the next is the revaluation. We said how you deal with the revaluation account. You compare the two accounts, the 2 years, and if there is a movement, that movement you must trace it up there under the non-current asset and ensure that you are upgrading your non-current assets. You are debiting your non-current assets. Then from there, from the revaluation account, we go to non-current liabilities. Most probably they are loans or debentures, or lease fees. So I think this one is usually straightforward. This one is usually straightforward. So you check the difference between the two. You check the difference between the two, and the difference between the two is either an increase or a decrease. An increase in the loans means we are getting more money, and therefore you take it to the financing activity, but you don't bracket it. When you reduce, it means you are paying. You take it to the financing activities, but you bracket it. You take it to the financing activities, but you bracket it. From the non-current liabilities, we know we go to what? We go to current liabilities. We go to current liabilities, and we know we have things like trade creditors. We know we have things like trade creditors. We have we start with the bank overdraft, bank OD, trade creditors, sundry creditors, and we know how to deal with them. We said we may even be having, like I was saying, interest payable. You may have interest payable. You may have dividend payable. You may have dividend payable. You may have dividend payable. You may have tax payable. You may have tax payable. You may have tax payable. Please mark this. If peradventure they are there, there's 3, and you have the income statement, they are supposed to help you reconstruct the accounts to know the actual payments. If you don't have an income statement, then you will treat them the way you treat the others. And we know how to treat the others. When the trade creditors increase, an increase in trade creditors is like people are giving us money. It's like people are giving us money, and therefore it is cash. An increase in trade creditors is like people are giving us money. An increase in trade creditors is like people are giving us money, and therefore we don't bracket it. But a decrease is like we are paying. It is like we are paying, and as we pay, there is a cash outflow. You deal with them that way. The rules for current assets, that is inventory, the trade debtors, sundry debtors, prepayment, the rules we follow is the opposite for current liabilities. The rules we follow is the opposite of current liability. After you have done that, I can assure you, you have covered more than 80% of the work that you need to do. From there, you prepare your statement of cash flows. You prepare your statement of cash flows, and I want to quickly give a format. I want to quickly give you a format and explain as I give it to you. I explain as I give it to you. Now, we know, you and me know, that we have two different formats of the statement of cash flow. We have the direct format and we have the indirect format. We have the direct format and we have indirect format. So, statement of XYZ, statement of cash flows. I will say direct method. This is the format for the year ended June 30th, 2025. So we say cash flow from operating activities. Cash flow from operating what? Activities. Cash flow from operating activities. And we start with profit before interest and taxes. Profit before interest and taxes. Please mark this. Please mark this. Please mark this. If you are reconstructing the interest account, it means that what was deducted in the income statement is not what was charged. It's not what was charged. And that's why we are saying we want to get a profit before interest and taxes so that we do not charge what was incurred, we only charge that which. We do not charge what was incurred, we charge what was paid. Remember, a statement of cash flows is a statement that shows the sources and application of funds in the course of the year. It's a statement that shows the sources and application of funds in the course of the year. And I like telling students this way. It is very easy to understand this statement if you approach it this way. You assume that the money we had at the beginning of the year, we never touched at the beginning of the year, and therefore we operated under operations. Under operations, we are saying the money we received minus the money we gave out. What is the balance? What is the balance? Now, under investing, the money we received minus the money that we paid, what is the balance? We add the two balances to know the overall net balance. Under financing activities, the money we received minus the money we paid, what is the balance? Now, once we get the three balances, the net position for the three balances will either add the money we had at the beginning, if it is positive, or it will reduce the money we had at the beginning, if it is negative, to give us the money we have at the end of the period. It is that simple. So we get the net cash flow from operating activities, we add net cash flow from investing activities, we add the net cash flow from financing activities, we get the total increase or decrease in cash and cash equivalent cost by the operations of the year. And that increase or decrease, if you add what you had at the beginning, you will get what you have at the end of the period. Let's look at it. So we're saying profit before interest and direct method, you don't do it that way. Direct method, you don't do it that way. You get receipts from sales, cash receipt from sales. Please mark this. It is cash receipt from sales of inventory. If we receive the money on sale of non-current assets, it will be a financing activity, because this one deals with the operating activity, the principal revenue generating activity of the firm. We want to ask ourselves, what money, after we bought and spent, as we receive money and spend, under the principal revenue generating activity of the firm, how much money were we left with? And once we were left with that money, we also ask ourselves, how did we use that money? Did we use that money to buy other non-current assets, or did we use the money to pay the loans which we had taken, or did we retain the money in the firm? How did we use the money which we generated from our principal revenue generating activities? So you may also say payments to suppliers, payment to suppliers. So it's a cash outflow. Payment to employees. It is a cash outflow. You may talk about other payments. You may talk about other payments. You may talk about other payments. And therefore, the difference, we get the cash and cash equivalent generated cash flow, net cash flow. We get the net cash flow from investing activities. So these are the monies we made. These are the monies we left after the money we received minus the money we spent under the operating activities. These are the monies we were left with. And we are asking ourselves, what did we do with that money? At the end of the year, do we still have this money, or did we spend the money under investing activities or the payment of loans? So we come here and we say cash flow from what? From investing activities. Cash flow from investing activities. Remember what we said investing activities are. Investing activities is everything non-current. It is everything non-current. Acquisition or disposal. But remember, in this statement, we only deal with the money. We do not deal with anything borrowed. We deal with the movement of cash and cash equivalent. So we come here and we say purchase of land and buildings. Money left, and because money left, we do it as negative. Purchase of investments. Money is leaving. These are long-term investments. Long-term investment. Short-term investments are part of cash and cash equivalent. So we talk about interest income from investment, interest income from long-term investment, interest income from long-term investment. So money is coming in, so this one you don't block it. We could also be having dividend income from investment in shares, Money is coming. We could even say disposal of motor vehicle. We received the money when we disposed a motor vehicle. Please realize that motor vehicle being a non-current asset, when we sell it, it's not operating, it is an investing activity. It is an investing activity. Now, by the way, ideally, these ones, we should be putting them inside. We should be putting them somewhere inside. We should be putting them somewhere inside. Somewhere here, investment. Somewhere here inside. This so that when we get the net position, we will bring them here. Please see the way I'm doing it. I'm not doing it here. I'm doing it below here, but outside, so that we can call it net cash flow. Net cash flow from investing activities. Net cash flow from investing activities. Investing activities. What are we saying? The money in from the non-current assets minus the money out. What is the balance? We get the balance here. Under operating activities, money in minus money out. What are operating activities? The principal revenue generating activities. Anything that relates to the principal revenue generating activities is the cash flow from operating activities. Something very, very important here. If you find this interest income in the income statement, or even dividend income in the income statement, you must deduct it. So that the only income you are dealing with, it is from operation. That is now at the indirect method. You must deduct this income because it is not an operating activity. It is an investing activity. I want to repeat again. If you have your income statement and it is showing you that there was a receipt of interest income or there was dividend income, and you are now trying to get the operating activities cash flow, you must deduct it as, you must adjust it by getting the profit before it. You say profit before dividends. Yes, profit before dividend and interest income. Profit before dividend and interest income, because those ones are not under operating activities, they are under investing activities. Again, anytime you see a long-term asset, under the non-current asset, it is an investing activities. Anytime you see a short-term asset at the current asset, you say from the bottom is get bank, cash, bank, and then investment. That becomes a cash equivalent. So you get net cash flow from investing activities. Then we go to the final one. Cash flow from what? Cash flow from what? Financing activities. Cash flow from financing activities. What are financing activities? It is anything related to long-term sources of funds. For instance, we may talk about issue of shares. Always put it on the inside. Activities. Issue of shares. Dividend paid. Now, when you issue shares, we receive money. But when we pay dividend, money leaves the firm. So we bracket it. So we may talk about loan repayment. If we are paying the loan, it could mean that we got money from operations and we paid the loan with it. Loan repayment. So money is leaving the firm. We could even talk about interest. If we are very clear, interest payment. We could talk about interest payment if we are sure that this interest is related to this particular loan. Now, once you get that, you add them and you get the total there. Please mark my words. Below the line, alongside that, just alongside, we talk about net cash flow from financing activities. Now, once we get the net cash flow from the operating activities, investing activities, from the operating activities, investing activities, and financing activities, once you add them, we are saying in this statement, we assume you have not touched the cash and the cash equivalent at the beginning of the period. And therefore, the two of them, if you add them, if you add the three of them, if you add the three of them here, yes, the figure you get there, we say net increase or decrease of cash and cash equivalent. Net increase or decrease of cash and cash equivalent. Net increase or decrease. We are saying that it is net because in every area it is money in minus money out the balance. Money in minus money out the balance. Money in minus money out the balance. We are saying it is net. It is net. And we are saying it is net increase. That once you get whatever figure you get after netting all of them is a net increase or decrease. Why is it increasing or decreasing? Because they are increasing what we had at the beginning of the period. They are increasing what we had at the beginning of the period. And so we say add cash and cash equivalent brought down. What we had at the beginning of the period, if it was a net increase, this increase plus this, what we had at the beginning of the year, we get what we have at the end of the year. We get what we have at the end of the year, we get what we have, cash and cash equivalent, balance carried down, balance carried down, balance carried down, balance carried down, balance, this balance brought down. Please, I want to move a bit slowly there because I want you to understand. People confuse this is one of the most simple statements to prepare. We are saying money in and money out on operating activities. And the operating activities, you must know, we are dealing with the things that affect the principal revenue generating activity of the firm. If we have invested in Safaricom shares and we buy and sell land, our principal revenue generating activity is buying and selling land. It is not selling of shares. So selling of shares, buying of shares become an investing activity. Our principal revenue generating activity. Now, once you get a principal revenue generating activity, you get the net balance, you add the net balance from investing and the net balance from financing. We are saying once you add them, they will either increase or decrease the money we had at the beginning of the year. So we say net increase or decrease of cash and cash equivalent. Net increase or decrease, because we will decrease what we had at the beginning of the year or we will increase it. So if it is negative, it will decrease. If it is positive, it will increase. So what we get, if we add what we had at the beginning of the year, we will get what we have at the end of the year. Remember, these ones will be there in the balance sheet. We have the two balance sheets, 2024 and 2025. 2024, we have inventory. We have, let me just get straight there. We have investment of 200, and here it is 400. We have bank of 500. Here it is 1,000. We have cash of 1,000. Here we have 2,000. Then at the current liabilities, we have bank overdraft, bank OD of 5,000, and here bank OD of 10,000. Never forget this. Cash, and to get this figure, cash and cash equivalent, we check in the in the balance sheet, at the opening balance sheet, you add the investment, bank and cash. I said if the investment is at the current assets, just above bank, it means that's what we are calling cash equivalent. And therefore, it is near to cash. So we consider it as though it is cash. So we add this and this and this, we get 1,700. We subtract overdraft because overdraft is negative. 1,700 minus 500, we get 1,200, and that becomes our opening cash and cash equivalent, 1,200. 1,200. Then in 2025, we add to get the cash and cash equivalent at the balance carried down at the end of the year now, we add them again. This is 1,400, this is 3,400. 3,400 minus 10,000, 3,400, 10,000 minus 3,400, 006, 9 minus 3, it is 6. Now, you can see here, our cash and cash equivalent at the end of 2025, it is negative 6,600. Negative 6,600. Now, if after adding these three, if after adding this and this and this, and adding this, we do not get negative 6,600, we have made a mistake somewhere. We have made a mistake somewhere, and we must look for a solution. We must look for a solution. Please learn how to look for cash and cash equivalent. Look for those items. Look for investment above bank, cash, and bank overdraft. You add them together knowing that the bank overdraft reduces our cash and cash equivalent, and then that's the opening. That's what you bring here. The net increase or decrease, you add what we had at the beginning of the year, and what we had at the beginning of the year is this one. Then you are supposed to get what we have at the end of the year. You shall, whatever figure you get, if it does not agree with the figure at the end of the year, it means you made a mistake. But if it agrees, it means you did it well. Thank you very, very much. Once again, I want to urge you, please subscribe, like, share, and hit the notification bell so that every time we are loading new videos, we are able to give you. By the way, we'll do several questions. We do several questions in terms of cash flow so that we can be able to practically explain by solving the questions. Thank you very much. So this is direct method. Please mark this way. We have two methods of preparation of the statement of cash flows, but the area for investing activities and financing activities remain the same. They do not change. They do not change. Everything else does not change whether you are using direct method or you are using indirect method. Indirect method only affects this area. Indirect method only affects the statement of cash flow from operating activities. It only affects that. And therefore, I'm just going to discuss cash flow from operating activities indirect method. I'm going to discuss cash flow from operating activities in the indirect method. The others are carried the same way. 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 Statement of we may statement of cash flows, XYZ, statement of cash flows for the year ended that year of June 25, that year of June 25, and as at that year of June 25, as at that year June 25, and we are saying cash flow from operating activities. Cash flow from operating activities, And we say profit before tax. Please, profit before tax. Now, this requires you to understand, not to memorize. You need to understand, not to memorize. Don't cram, understand. Don't cram, do what?
Understand.
Do understand. Do understand. You must remember the format of the income statement. You must remember the format of the what?
Income.
The format of the income statement is profit before interest and taxes. Before interest and what? Taxes. We say less income tax expense. We get profit before tax. We say less tax. We get profit after what? Profit after tax. And you must realize, if we had any interest income, it was captured there at the beginning. When you get profit from operations, you add other incomes, that is, interest income and dividend income. Meaning, by the time you're getting this profit, we have already captured those incomes. You've already captured those what? Those incomes. And therefore, when we come here to adjustment, because we are saying we only want to get what belongs to operations, and we are saying that interest income and that dividend income is not from operations, because that is not our principal revenue adjusting, generating activities. So when we come here and we say adjustments, whatever we had added there, and it's not related to operating activities, or it is non-cash, we do the adjustments. So we adjust interest income because we had shown it as our money and our operating activities. Now we deduct. Interest income, because we are saying interest income. If it's for a long-term investment, this interest income belongs to investing activities. Then we talk about dividend income. If we had bought shares, and we had shown it as an income up there, it is not an income. It's not an operating activity income. It's not an operating activity income. And therefore, because we want to get profit before tax, maybe we have been given profit after tax. If you have been given profit after tax, we say add back income tax expense. Income tax expense. So, what are we saying? We are adding it back. Because this is what was incurred instead of what was paid. So we reconstruct the interest, the income tax account to get actual payment. Please mark this. Tax is an operating activities because we are being charged that tax because of our operations. So we are adding what we deducted as an expense so that down there we can deduct what was paid. What was incurred, we add back so that we can deduct what was paid. Some people will come here and say profit before interest and taxes. And therefore you don't need to do this. If you get before interest and taxes, you don't need to add back income tax expense. So, then we talk about depreciation. We had deducted depreciation, and depreciation is not a cash outflow. So, we add it back. Then we talk about gain on disposal. Gain on disposal of an asset. We had added it, now we deduct. Because we had added it there, but never brought money, now we deduct. So we get the net cash flow before working capital expenses. Net cash flow before working capital expenses, working capital adjustments. Before working capital adjustments. And therefore we come here and we say working capital adjustments. Working capital adjustments. Working capital adjustments. working capital adjustment, and we have something we are calling inventory increase. If our inventory increased, an increase is an application of funds, and therefore money is leaving the firm. Debtors reduction is like we are collecting debtors. Debtors decrease is like we are collecting debtors, money is joining us. If we have sundry debtors decrease, sundry debtors increase, sundry debtors increase, it is like we are giving people our money. So it's a cash outflow. Now, the liability is the opposite of current assets. Trade creditors increase. An increase is like somebody is giving us money, is lending us money, and therefore it is money joining us. Other creditors decrease. It's like we are paying. If it's a decrease, it's like we are paying, and therefore it's a cash outflow. Now, once we get this, we get the net cash flow, working capital adjustment, net working capital adjustment, net working capital adjustment. We can actually take it there. You can actually take it there. Then we now deduct. We added back tax, income tax expense, because we don't want to deduct what was incurred. We only want to deduct what was paid. So we less income tax expense. Income tax expense paid. Expense paid. And we get net cash flow from operating activities. Net cash flow from operating activities. Please mark, we are adding back tax which was deducted, because what was deducted is not what was paid. Then we are subtracting what was paid. We are subtracting what was paid. We are adding it back because it is usually higher than what was paid. So that we add it back and then we deduct what was paid. We deduct what was paid. We deduct what was paid. That's the way to prepare the statement of cash flows in direct method. Indirect method. Indirect method. Indirect method. Indirect method. Thank you very much. Please, I want to repeat again, subscribe, like, share, hit the notification bell so that every time we have a new video, we shall be informing you. We shall be informing you. Thank you very much.